How things have changed since I wrote 2 weeks ago the case for a fourth quarter rally. At that time, the S&P had just closed at a new low for the year, and many were predicting an imminent breakdown in the market. Instead, the market reversed powerfully 2 Tuesdays ago and has levitated since then, with the S&P up 150 points or 14% from its intraday low. At this point, things may have moved a little too far, a little too fast. Technically, we are back at the top of the range that has snuffed out any rallies since August, as you can see from the accompanying chart. Further, volume dropped off notably last week, with NYSE composite volume down 27% from the week before. In fact, not a single day's volume last week was above the 50-day moving average, and 4 days were more than 20% below it. That's a thin market susceptible to being pushed higher by momentum traders and hedge funds trying to wring every last point out of the rally. I'm still constructive on the market through year end for the technical and seasonal reasons I outlined in the case for a fourth quarter rally, but I would wait for a better entry point even after today's sell-off. If and when it presents itself, I like technology as a way to play any year-end rally. While financials are oversold, the most oversold and the cheapest, they are also the riskiest. Who knows what their true exposure is to Europe? What happens to them in the event of a financial market meltdown? By contrast, the tech sector has very little debt and a high quality of earnings. Technically, tech has had superb relative strength since the beginning of July. Indeed, the S&P tech sector is flat since then, compared to negative 8% for the S&P 500 as a whole and negative 20% for the S&P financials. You can take a look at the accompanying chart in my client note, and it really shows how strong tech has been, relatively speaking. Jim Cramer was very persuasive in pounding the table for tech over financials on Mad Money on Thursday, and I definitely recommend watching it. Cramer is extremely knowledgeable, and he knows a lot of different things. He doesn't necessarily always put things together in the right way. He's not perfect, but in this case, as in many other cases, he's done a good job of putting his finger on something important. My personal favorites in the tech space to play fourth quarter rally are Cisco and Hewlett Packard. Fundamentally, both of these stocks are extremely cheap, with Cisco trading at 7 times and HP 5 times the last 4 quarters earnings. Technically, both have put in solid lows in the last couple of months. As you can see, Cisco put in a pretty solid low on heavy volume at the beginning of August, around $14 a share. And HP has formed a nice base in September at around $22, $23, and that provides solid support as well. As a result, both of those stocks offer a compelling way to play the seasonal tailwinds into year-end with a nice margin of safety.